It's 7:14 in the morning. You haven't even brushed your teeth yet, but your thumb is already swiping. Red. Your stomach drops. You check again at 9:30 when the market opens. Green now, but barely. By lunch, you've looked 6 times. By dinner, 11. You tell yourself you're being responsible, engaged, smart. But here's the thing nobody tells you. Every single time you check, you're making yourself a worse investor. Not slightly worse, measurably, dramatically worse. Let me tell you about Marcus. He's 41, works in software, makes good money. 3 years ago, he started investing seriously. Did everything right. Read the books, opened a brokerage account, put together a diversified portfolio. Index funds, some bonds, a few individual stocks. He felt proud, responsible. Then he downloaded the app. At first, just curiosity, a quick check in the morning, maybe one at lunch, but the app made it so easy. One tap and he could see exactly how much richer or poorer he'd gotten since breakfast. The problem? Marcus didn't realize what he was actually looking at. He thought he was watching his wealth grow. What he was really watching was noise, pure, random, meaningless noise. Here's a number that'll change how you think about this. On any given day, the stock market has roughly a 53% chance of going up, barely better than a coin flip. But zoom out to any given year, and that probability jumps to about 73%. Zoom out to any 10-year period, and it's been positive over 94% of the time. The longer your time frame, the more signal emerges from noise. The shorter your time frame, the more you're watching static. Marcus was checking daily, sometimes hourly, which means he was watching a coin flip and reacting to it emotionally over and over again. Each flip felt meaningful. Each flip felt like information, but it wasn't, just randomness wearing the costume of data. Now here's where human psychology enters the picture, and this is where things get dark. There's a concept in behavioral economics called loss aversion. Losing money feels about twice as painful as gaining the same amount feels good. Lose $100 and the sting equals the pleasure of gaining $200. This isn't a character flaw. It's hardwired into your brain. It kept your ancestors alive. But in modern investing, this ancient survival mechanism becomes a trap. Think about what happens when you check your portfolio every day. There's roughly a 47% chance you'll see red, a loss. And because of loss aversion, that loss hits twice as hard emotionally as an equivalent gain. So even in a market that trends upward, your daily emotional experience is net negative. You're winning financially, but losing psychologically. Marcus didn't understand this. He just knew checking his portfolio had started to feel bad. He'd have a great day at work, see red, and his mood would crater. Trouble sleeping on down days, euphoric on up days, then anxious about giving back gains. His portfolio hadn't changed much, but his relationship with money had become toxic. And here's the insidious part. The stress wasn't just making him feel bad, it was making him make terrible decisions. Researchers at UC Berkeley found that the more frequently investors checked their portfolios, the more likely they were to make changes. Not good changes, panicked changes, buy high, sell low changes. Daily checkers traded nearly 4 times more than quarterly checkers. All that extra activity didn't make them richer, it made them poorer. One landmark study followed tens of thousands of individual investors over several years. The ones who traded most frequently earned returns about 6.5 percentage points lower per year than the overall market. Per year! Do you understand what that means over a lifetime? If you invested $10,000 at age 25 and just left it alone until retirement, you'd have roughly $380,000 at average market returns. But if you were one of those frequent traders, constantly reacting to daily movements, you'd have about $120,000. You gave up $260,000 for the privilege of feeling like you were doing something. Marcus was becoming one of these traders. He didn't mean to be. He'd start the day with a plan to just hold, stay the course, but then he'd check, and he'd see a stock dropping, and that loss aversion would kick in, and before he knew it, he was selling.
Then the stock would recover, and he'd buy back in, but now at a higher price. He was buying high and selling low, the exact opposite of what every investment book tells you to do. But he couldn't help it. The daily checking had hijacked his emotional circuitry. Here's another number that puts this in perspective. The average stock market correction, meaning a drop of 10% or more, happens roughly once per year. But if you zoom in to daily movements, drops of 1% or more happen roughly 25 times per year. If you're watching every day, you're experiencing what feels like mini crises 25 times annually. Each one triggers your fight or flight response. Each one makes you want to do something, but doing something is almost always the wrong move. The best investors in history understood this intuitively. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." He doesn't sit there watching tickers all day. He buys companies he believes in and then basically ignores the daily price movements for years, sometimes decades. His favorite holding period is forever. That's not folksy wisdom. It's a psychological strategy to avoid the trap Marcus fell into. Now, I want to tell you about something called the checking experiment that really drove this home for me. Researchers created a simulated investment game. They gave participants a portfolio and let them decide how often to check their returns and whether to make changes. One group could check as often as they wanted. The other group could only check once per month. Same market conditions, same starting portfolio, same investment options. The results weren't even close. The group that could only check monthly ended up with portfolios worth about 25% more than the group that checked constantly. 25%! Just from looking less often. Why? Because the less you look, the less noise you see. The less noise you see, the less emotional damage you take. The less emotional damage you take, the better your decisions become. It's not about being uninformed, it's about being informed at the right frequency. Here's what finally happened to Marcus. After 3 years of this cycle, his portfolio had grown maybe 12% total. The market over that same period was up almost 40%. He'd lost nearly 30 percentage points of return through all his watching and trading and reacting. That's when it hit him. His vigilance wasn't protecting his money. His vigilance was the thing destroying it. So he did something radical. He deleted the app. Not just moved it to another screen, deleted it entirely. He set up automatic contributions to his investment accounts and decided he would check his portfolio exactly twice per year. Once in January, once in July. That's it. The first few weeks were brutal. He'd reach for his phone out of habit and feel genuine anxiety when he couldn't check. It felt irresponsible. But here's what he noticed. His mood stabilized. He slept better. He stopped thinking about money constantly. And when his 6-month check-in came around, his portfolio was up 11% in just 6 months. Not because the market was better, but because he had stopped sabotaging himself. This is the paradox nobody tells you about investing. The less you pay attention, the better you do. Not because information is bad, but because daily information in financial markets is indistinguishable from randomness. And watching randomness while your brain interprets it as meaningful signal is a recipe for terrible decisions. So what do you actually do with this? First, separate monitoring from checking. Monitoring means having a system that alerts you if something genuinely important happens. Checking means manually looking at prices to see if numbers went up or down. You need monitoring, you don't need checking. Second, set a review schedule and stick to it. For most people, quarterly is plenty. Some do twice a year. The specific frequency matters less than having a rule and following it. Fourth, make checking harder. Delete the apps, remove the bookmarks. Every barrier you put between yourself and that red-green number is money in your pocket. Fourth, automate everything. Automatic contributions, automatic rebalancing. The less you need to manually do, the less opportunity you have to react emotionally. The market will do what the market will do. It'll go up, it'll go down, it'll terrify you. But over the long run, for over a century now, it has relentlessly moved upward. The only thing standing between you and those returns is your own inability to sit still. Your portfolio doesn't need you to check up on it. It's not a child. It's a mathematical abstraction that performs better when ignored. The wealthy don't watch the market every day. They check in occasionally, make thoughtful adjustments, and go live their lives. The people who watch constantly are the ones funding everyone else's returns. Which one do you want to be? If this changed how you think about investing, subscribe. We break down the psychology of money every week. I'll see you in the next one.